Hi, my name is Brenton Harrison, and we're here today to talk about a particular type of mortgage financing called an ARM, or an adjustable rate mortgage. Let's get started. If you're watching this video, you probably feel like you are at your wit's end as it relates to your home search. There have been so many negative things that have happened in the economy over the last few months. The stock market is falling. Mortgage interest rates have risen 2 to 3% over the course of a few months. So now the homes that you were looking at when you started that home search, after factoring in those higher interest rates, the payments put you in a position where you can't even look at them anymore. 2 or 3 months ago it was affordable. Now you're having to lower your price point to account for those new mortgages. We've also seen the Fed say that they were potentially going to increase those rates another 2 to 3 times by the end of the year 2022, meaning that you don't even know how high they will go, and you want to try to do things like lock in the rates for different homes that you're looking for, but you're having trouble finding that balance. We also are seeing in really hot markets like where I am in Nashville, people who are bidding $25,000, $35,000, $40,000, $50,000, $60,000 above the asking price of a home. So even when you find one in your price range, you're losing out to these buyers who somehow are able to come up with this money that you could never dream of offering as a lump sum above and beyond what the person asks for. So many things, as I said, that put you in the position where you're just wondering, is now even the right time to buy? But there are other people who are watching this video and are determined to find that home. You're trying to get into that house come hell or high water, and it's found you looking for alternative sources of financing that are different than the traditional 15-year loan, 30-year loan, just trying to find any way you can to save some money on that interest rate, to save some money on that payment. And you're basically saying, I'm going to kick the can down the road and do whatever I can to get in that house now, and I'll figure out the rest later. Well, that second camp seems to be the larger camp, because in recent months, we've seen more and more people turning to these alternative forms of financing to try to get into that property. And it's brought back into the equation a form of mortgage loan that really was villainized, and rightfully so, as a result of the 2008 mortgage crisis. And that type of loan is an adjustable rate mortgage, or an ARM. An adjustable rate mortgage is a unique opportunity where you have a home buyer who's able to get a loan where they pay based on a fixed interest rate for a set period of time, and after that set period of time expires, their lender can adjust the rate to reflect the current market conditions. ARM loans are rising in popularity in recent months because the typical ARM loan interest rate that you're going to receive is lower than what you'd find with a 15-year or a 30-year mortgage, where the rate is fixed throughout the entirety of the period. Now, those potential rate increases represent a really large risk to a home buyer who's looking into an ARM loan, hoping that they can secure those temporary savings. But as home values keep increasing, as interest rates keep increasing on these mortgages, understandably, homeowners are simply saying, I will kick the can down the road, hope that I don't have to pay the piper when that time comes. I know that's a lot of metaphors, but you can understand if you're in this situation where looking at a lower interest rate through a potential ARM would be attractive. But before we get into this, I want to make sure you have an understanding of how do ARMs work, what is some of the terminology. There's some really funky terminology when it pertains to ARM loans. And after we've done the basics, we can discuss whether an ARM is a potential solution for you, or whether you need to run in the other direction and wait until interest rates hopefully settle down. We've already covered that with an ARM, an adjustable rate mortgage, the interest rate can adjust. And when you have a fixed rate mortgage like a 15-year loan or a 30-year loan, you don't even have to worry about this. The hardest part is figuring out what your interest rate will be on the front end. But after you figure out that rate, it's not going to change. With an ARM, however, there is a period in time where that interest rate will change, and it will do so based on the performance of its underlying index. Now, in mortgage terms, an index is simply an interest rate that your lender is going to use as a benchmark to decide what they're going to charge borrowers who have certain debt instruments, like in this case, an ARM loan. And depending on the lender, the indices from which they choose can vary. You have certain lenders who will use the treasury yield of the 1 year, the 3 year, the 5 year treasury yield. You have others who will use the LIBOR rate. You will have others who will use the COFI rate. It all depends on your lender. lender and you want to make sure if you're considering an ARM loan that you ask that lender at the front end, what index do you use to set your interest rates? After determining the index that they're going to use to set their rates, your lender is also going to add a margin or a buffer interest rate that makes sure that they preserve their ability to earn a profit on these ARM loans that they're offering to consumers. As an example, let's say that we have a lender who is using an index plus margin of the COFI plus 2.5%. That's what they're using to set the rates for their ARM consumers. This would mean that if you have a COFI rate of 4.5% and you're applying for an ARM loan, the initial interest rate that you pay on that loan would be 7%, the index plus the stated margin percentage. And just so we have an example from which we can build our knowledge, throughout the rest of this video, that's going to be the example that we use. We're going to use a home loan that's an ARM loan, an adjustable rate mortgage, and the index plus margin is going to be the COFI rate plus 2.5%. Now, here's an example of what a rate quote from a lender might look like if they're giving you a loan based on these terms. As you can see, we have our stated index plus margin of the COFI rate plus 2.5%, and that leads to an initial interest rate of 7% because, as we covered in this example, that index rate is 4.5%. You see terms like minimum, maximum interest rate, change frequency, limits on rate changes. We'll cover everything below as we go throughout this video, but we're going to keep coming back to this example as a point of reference. The fixed period and change frequency is really the first time that you're going to see some of the confusing terminology that's associated with ARM loans. And they throw out these terms if you're considering these loans that make no sense if you're a layperson. You'll hear someone say, oh, I have a 5-1 loan or a 1-6 loan. All these different numbers that make no sense when you see that date format of X/X. So let's talk about what those numbers mean. The first number tells you the number of years that you're going to have that fixed period where the rate can't change. So if, for example, I have a 5/1 loan, that first digit, the 5, is saying that my fixed period will be 5 years long. Whatever my initial interest rate is, it will stay at that rate for that initial 5-year fixed period. The second digit, the 1, in this example, a 5/1 loan, is telling you after that fixed period how frequently the interest rate can change. Now, this is an adjustable rate mortgage, so the rate can adjust, but they can't just adjust it every day, even if they're looking at an index that changes as frequently as every day. There's a limit to how often they can adjust that rate. So that second digit tells you how frequently they can do it. If you have a 5/1 loan, you have a loan whose fixed period for that initial interest rate is 5 years, and following that 5th year, the rate can change as frequently as once per year. Now, using that same example, you need to understand that if you see something that says 5/6, that does not mean that you have a fixed period of 5 years, followed by a period where they can only change the rate every 6 years. A 5/6 loan means that the 5-year period is the fixed rate, and after that, they can change the rate as frequently as every 6 months. Now we're back to rate caps, and we referenced these initially when we talked about different examples. And what the rate caps do is they really give you an idea of the potential movement of these interest rates after the fixed period. So we've used an example of a loan that has a 5/1 term. So after the first 5-year fixed period, the rate can change as frequently as once per year, and you have that loan for an entirety in this example of 30 years. So a 5-year fixed period followed by 25 years where the rate could change every single year. Now, what the rate caps do is they give you a date format of X/X/X, and each of the numbers in this term sequence tells you something about the potential movement of that loan. Let's go back to our initial example of a 5/1 ARM at 7%, and we're going to use the caps of 3/2/5 to explain what each number in the sequence would mean. The first number represents the largest increase or decrease that's allowed in the initial adjustment following the fixed period. So in our example, 3% is the largest swing up or down that you can see in your mortgage following that fixed period of 5 years. This would mean that in year 6 of our loan, because remember, it's a 5-1 loan, so year 6 is the first year that rate can be adjusted, our rate can climb no higher than 10%, but it can fall no lower than 4%. That's 3% on either side of our initial interest rate of 7%. The second number represents the largest increase or decrease allowable after the first adjustment, which our example would be year 7. So let's assume that in the first adjustment after the fixed period, which would be year 6, our mortgage rate increased to say 10%. Now the second cap, 2%, would restrict any increases or decreases to a range of 12% and 8%. That's 2% on either side of the interest rate after the fixed period. Now, the third number represents the largest increase or decrease allowable throughout the entirety of the loan. And this is where the minimum/maximum rate comes back into play, because the maximum rate is the ceiling and the minimum rate is the floor for the interest rates that should also be stated in that loan estimate that's provided by your lender, as well as the closing disclosure documents you get prior to closing. Now that you know how an ARM works, we need to discuss whether it's right for you. Who should use an ARM? Is it right for you? Is it right for someone else? With rising interest rates, with rising home values, is this really a good opportunity for someone who's trying to squeeze in the door of that home? Or is it something where you should say, hey, even because other people are doing it, it doesn't mean it's right for me? Well, I tell you, in my experience, there are a number of questions and check boxes that you need to mark off before you can say that you are definitively a good candidate for an ARM loan. One of those check boxes is you not moving into a home that's your dream home or your long-term home. In most cases, when I'm dealing with someone who's pursuing an ARM, one of the first questions I ask them is, how long do you plan to be in this house? If this is the house that you plan to be in for 20 or 30 years, you're going to have to check all the boxes that come after this first one that I'm describing to you to make sure that it's a good fit. But if you're planning to be in that house for 3 or 5 years and you have a 7-year fixed rate, for example, it is a potential opportunity for you to take advantage of these temporary savings for a house that you plan to leave before the fixed period ends. Now, you may not know that to be true. You may be speculating in terms of how long you plan to be in that house. And if that's the case, what I would tell you is, if you're in this situation and you don't think it's your dream home, even if you end up being wrong, you still need to have a plan of action just in case you get to the end of that fixed period, interest rates have risen higher than what you'd be able to pay. You need to know that there's a plan in place to potentially leave that home and hopefully do so at a profit. The second question to ask yourself is, are you pursuing this ARM for an expensive home? And as odd as it may sound, in my opinion, an ARM is actually better suited for an expensive home than it is for a starter level home. And this is all about economies of scale, because one of the major cons about pursuing an ARM loan is that you don't know what that interest rate will be after the fixed period. But the pro is that you likely are going to get some temporary interest rate savings as a result of choosing it over a 15 or a 30-year loan. Well, based on economies of scale, that interest rate savings is simply going to be more significant if you have a more expensive home than it would be if you're pursuing this home for a starter home. And you really want to only take on the risks of that ARM loan, in my opinion, if you're getting significant savings by doing so. As an example, let's say that we have a person who's pursuing a 30-year loan on a $600,000 mortgage at 5%, and they're comparing it to an ARM that has an initial interest rate of 4%. So 1 percentage point difference that they would be saving. Well, on that $600,000 loan, the monthly savings in terms of the principal and interest payments alone would be $357 a month. Now, that's significant savings for someone who might be pursuing a temporary home that's not their dream home in an area that's just red hot in terms of home values. And if they're just trying to get in the door and find something without being priced out, but they know it's not a long-term solution, an ARM is a potential option that would keep them from having to pay that higher amount. Over $357 in savings each month is nothing to sneeze at. Now, conversely, a person who's considering that same exchange, a 5% mortgage of $250,000 for 30 years versus a 4% mortgage of $250,000, that's an ARM, is going to save about $148 a month. Now, all money has value. I'm not saying that that's no money, but to me, it's not enough to take on the risk of going into an ARM where the interest rate could go way higher than what you could afford at the end of that fixed period. They might instead be better suited for paying that extra $148 and pursuing that long-term fixed option so that they know what their interest rate and what their payment will be for the entirety of the loan, rather than taking the risk of getting a big surprise at the end of the fixed period through an ARM. The next question to ask is, are you going to make a substantial down payment? And this question is all about you understanding the equity of your home in the event that you would want to refinance an ARM loan to a fixed rate loan. So there are a lot of people who get into ARM loans knowing that they want to get out of those loans and refinance them to a fixed rate loan as soon as possible. It may be that you got an ARM loan and you were just trying to save some money and money was tight at the time. It may be that your credit wasn't in a strong enough place to get you that best fixed rate loan that you needed. So you're saying, hey, I'm going to get this ARM so I can get in the house. After I've been in the house for a few years, I'm going to refinance as soon as possible. Well, that can be a good plan, but it really only works if at the time you refinance, you have enough equity in your home to do so. So you can get into an ARM loan, and when you refinance that loan, most lenders are going to want you to have at least 20% equity in your home. So that means that whatever the appraised value of your home is, the mortgage balance that you have needs to be no more than 80% of that loan balance for you to be eligible for a refinanced home. I'm going to use big numbers. Let's say that you have a $500,000 appraised value of your home and you're trying to refinance an ARM loan. Well, when you go to the bank, they're going to want to make sure that you owe no more than $400,000, 80% of your appraised value, in order to refinance that property, because now you owe 80%, but that remaining 20% is your home equity. It makes sure that the lender is not putting themselves at risk of giving money to a home lender who's right at the edge of their home value when it comes to how much they're asking to borrow. The problem with that as it relates to ARMs is if you're putting yourself in a situation where you're not making much of a down payment when you get that ARM, you also are not getting much initial equity at that purchase. So for example, you might have an ARM loan and you put down 5% at the time of purchase. Well, if you put down 5%, you only have 5% equity in that home. And if the home value doesn't increase, and in fact, in some cases, home values are decreasing, you could put yourself at risk where even when you're ready from a credit perspective and an income perspective to refinance that loan to a fixed rate, you don't have enough equity in the home to do so. That's in a good scenario where it's like, hey, I don't have quite enough equity, but I still have equity. The worst case scenario is you could put a small down payment on an ARM loan and the home value could decrease to the point where you have less in terms of what the home is worth than what you owe on the property. So now you are underwater. You owe an amount on your mortgage that is more than what your home is worth. So you definitely can't refinance a home that is underwater in terms of its value. So you're either stuck with that property in terms of just continuing to pay, hoping that the tide turns. And if you remember people who had these loans in 2008, sometimes the tide never turned and they had to sell a home that was worth less than what they owed on that property. And that process is called a short sale. And it's never a position that you want to be in as a homeowner. The next question is, will you have the potential to refinance in terms of what your finances look like or will look like in the future? As I mentioned, there are a number of people who will get into these ARM loans hoping that they can refinance to a fixed rate loan as soon as possible. Well, in addition to the value of your home and the equity coming into play, your finances also come into play. We've talked about this in the past, but the two major elements of qualifying for a home loan is your credit score and your debt to income. income ratio. Credit score is what determines the interest rate that you could receive on a home loan. So a person with a better credit score might get a 4% loan, whereas someone with a worse credit score might get a 5% loan. But debt to income ratio is what determines how much you can borrow. They look at what your debt is relative to your monthly income, and you have to have enough wiggle room there to qualify for that new home loan. So if you're hoping to do this, if you're getting into an ARM loan in a temporary situation, hoping that as soon as possible you can refinance to a fixed rate loan, you need to have a plan in place to make sure that those variables, your income, your debt to income, and your credit are in tip-top shape at the time that you're planning to apply for refinancing. The last question is, will the potential maximum rates be something that is feasible for your budget, or would it be something that would be a financial calamity? Now, an ARM loan can really get high in terms of the interest rates. As a matter of fact, in the example that we're using, we've been talking about a rate that could climb as high as 12%, and that's obscene. And you would ideally never be in a position in this interest rate environment, even though rates are rising, where you're paying 12% on a home loan. But my opinion in terms of how you should go about financial decisions is to prepare for the worst and hope for the best. So I always, if I'm going into a situation, I'm going to hope for the best, but I'm going to figure out, am I going to be able to sustain this financially if the worst occurs? So what's the worst occurring with an ARM loan? It would really be interest rates rising to the point where you could pay the potential maximum of the rate that's listed in your ARM loan, and you being unable to sell that home or refinance that home, meaning that you're stuck at that interest rate. And I would want you to know going into an ARM that even though that's a worst case scenario, that maximum payment would not absolutely blow up your finances. Now, I will say for probably 95% of the people that I've discussed this with, it would absolutely blow up their finances. But there are some scenarios where that wouldn't be the case. One example would be any profession where your income rises significantly at a pretty predetermined process or path. So let's say that you have a medical resident who is able to secure an ARM loan for a home loan while they're in training, and that max payment wouldn't be something that they make now, but they're going to be out of training when the fixed rate period ends and making significantly more money. 2 times, 3 times, 4 times, 5 times more money. So even though that max payment isn't ideal, it wouldn't be something that will blow up their budget because they'll be making more at the end of that fixed rate period. The same might be true for a professor who is on tenure track, but right now is an associate professor. It would also be true of a therapist who is able to get a home loan while they're completing their licensure, knowing that once they finish their licensure, their income should jump significantly. So that would be one example, but another would be someone whose expenses are going to decrease significantly. You might have kids in the house where you're paying for daycare expenses, but by the time that fixed period ends, they'll be in public school. You might be in a position where you're paying off student loans and they're going to be paid off in the next 3 or so years. So by the time your fixed period ends, those student loan payments will be off your back, and you could, if necessary, withstand a great increase in your home loan payment. So when you're going through all these questions, the question is not, do I check off every single one of those boxes? It's whether you can check off the ones that are relevant to your situation to make sure that you are a good candidate in the short term and long term in terms of how an ARM would affect your financial plans. That's it. I hope this video was helpful in explaining the pros and cons of ARM loans and giving you some questions to ask so you can know whether it's the right thing for you. As interest rates continue to rise and home values continue to rise, I predict you're going to hear this term way more frequently. And if you are on that home search, you're probably going to consider it at a level that you hadn't prior to watching this video or prior to seeing this increase in home and interest rates. Whatever situation you find yourself in, again, I hope this was helpful. I definitely wish you the best on your home search, and I hope that you will continue to watch these videos because we'll keep bringing you content as frequently as we can. And in order for you to see it, you got to subscribe to this channel and subscribe to the notifications so that you can get that content as soon as it pops up. I'll see you soon.